Joining me now for our semi-annual chat is David Rosenberg. David, thanks for joining me on Weekly.
Well, thanks for the invite.
So just before Christmas 2018, you suggested that the U.S. would be in a recession by now. GDP is not rocking, that's for sure. And when you exclude inventories and trade, final domestic demand was roughly 1.5% in Q1 and looks lower in Q2. But are we in a recession yet?
Well, you know, what's interesting is that most people believe that a recession is back-to-back quarters of negative GDP. That's not anybody's definition of a recession outside of people on Wall Street or Bay Street. In fact, you don't even need GDP to go down in a recession. Normally it does. The National Bureau of Economic Research, who Martin Feldstein, God rest his soul,
Yes.
used to head.
He passed earlier this week.
Yeah, so the bottom line is that the NBER are the arbiters of a recession, and we don't usually know about the recession until about a year after it starts, because that's when the NBER tells us. But it's really about four basic metrics: real business sales, industrial production, real personal income, excluding government transfers, and employment. And if you look at household employment, you look at real business sales, you take a look at industrial production, which, by the way, is in a recession, and you're taking a look at organic real income, by the way, in the United States. Organic real personal income peaked in December. So I would actually say that the surprise is that the recession has actually already started ahead of what GDP is doing.
I got to ask you, you threw the word organic in there. What do you mean by organic income?
I mean real personal income excluding government transfers, including government receipts. So basically, mostly your take-home pay from your job.
So does the Fed cut next week? 23% probability out there right now that they will.
Well, I don't know if they will. Do I think they should? I think they should. Do I think that they should have bypassed the December 19th rate hike? Probably one of the few things I ever agreed with Donald Trump on was that the Fed has really overstepped. I have a different definition of what observable inflation is in the United States. It's not the core CPI or PC deflator. It's the inflation metrics in goods and services that excludes all the stuff that the government statisticians impute or trying to guesstimate at.
Right.
The underlying inflation in the United States is a fraction of 1%.
Owner's equivalent rent.
Exactly.
Like
a financial service. How do you measure a lot of this stuff in health services? When you look at the observable inflation and then you back out what the neutral funds rate should be, this is my opinion, the neutral nominal funds rate in the United States is close to 1.5%. The bright lights at the Fed thinks that it's closer to, say, 2.5%, and that's where they've taken the funds rate to. I think they've over-tightened by at least 75 basis points. I think at a minimum they have to walk that back. I'd like to see them cut interest rates. I think they should. Certainly where inflation is, an inflation expectation, that gives them the cover. But, you know, the history of the Fed is that this is an inherently incremental, slow-moving institution when it comes to making a big shift. But, Andrew, when they make this shift, rates are going to come down and come down by a lot. And so if it's not going to be at this coming meeting, it'll certainly be, I think, by the end of July.
Well, this graph that I'm showing our viewers right now, 20-year graph, and it takes the yield on a 2-year government bond in the States, subtracts Fed funds, and as viewers can see, for the third time in the last 20 years, it is telling you that the Fed's actually going to cut, and the numbers imply the Fed's going to cut 3 times this year. So you're suggesting that the Fed should cut next week, probably won't, will cut in July, will cut again later this year? How many cuts do you think is going to happen?
Well, it's a great question because the market's got 3 cuts priced in. For this year, it's probably appropriate. I guess the question you'd ask the economists is, you know, where are the risks? Do they do less than expected or do they do more than what's priced in? And here's what I'll say. Even in the context of a soft landing, which is usually pure luck, or when the Fed cuts interest rates that have nothing to do with a recession, like the stock market collapse of 1987 or, say, what they did in 1995 and again in 98. They can cut interest rates and not have a recessionary environment, or they can cut rates and have a recessionary environment. Either way, rates are coming down a lot. They never cut rates less than 3 times, even in the context of a non-recessionary economy. Now, if I'm right, by the way, if I'm right that the economy is actually in a recessionary state and will probably more further into that state in the next year, rates at the front end of the curve, the overnight rate is going to 0, we're going back to the zero bound. And in fact, I don't know why that comes as a surprise to people. The Fed's already told us that. And so the whole yield curve is going to steepen and it will melt. And so when people ask me, where are bond yields going? Well, look at where the UK gilt is right now. The 10-year gilt is 0.8%.
The Aussie got below 1 yesterday.
Right, and what I'm saying is, well, we will converge. The convergence will be, and I'm not talking about negative yields in Germany or Japan. I'm not going there. I'm saying at a minimum, the 10-year Treasury note at call it 2.1%, 2.2%, is going to converge on where the UK is. Actually, people don't realize if you're adding duration to your bond portfolio, the prospect of making double-digit returns in the next year are going to be very high.
So are you suggesting, for example, when it comes to GDP growth rates, that in the back half of this year, the U.S. is going to print 1%, 0.5%, numbers along those lines?
Yeah.
Okay.
At a maximum. And don't forget, you're talking about really negative real per capita numbers.
Understood. Okay, so then the Fed is likely going to cut 2 times, 3 times this year and continue to cut next year? Is that what you're suggesting?
That's my forecast. The consistency here is that if we go into recession, and I think that those risks are high and rising, and I think that the process has already started. I'm trying to convince people you have to look beyond GDP. It is not the only measure of economic activity. We're not only going back down to zero, we're going back into QE, and then the Fed will have to get even more aggressive after that.
And is China-U.S. trade irrelevant to your call here?
It's a look.
Or
it's
almost
obviously
irrelevant.
It's a complication. It actually helps out my call because it's obviously adding to uncertainty. It's causing capital spending to stay on the sidelines. It's actually, people think that the tariffs are an inflationary force because of the costs on imports, but there's a huge deflationary impact on aggregate demand because spending freezes up. People always ask me, how do you model uncertainty as an economist? Well, you model uncertainty by the fact that the savings rate in the private sector goes up because your preference for liquidity, preference for savings over spending. Now, it's not just that, by the way. The other thing, keep in mind, it's not just about China. You've got the U.S. elections in 2020. You're a business right now. You really don't know what your tax rate's going to look like. So right now, capital spending, that's the key. Capital spending and hiring intentions is going to follow, which has an impact on consumer spending. But capital spending is frozen because of these uncertainties right now.